Legal disclaimer. Before we begin, please remember that this video is for educational purposes only. It is not financial advice. Every investor's situation is different. Always do your own research or speak with a qualified financial professional before making investment decisions. What are covered call ETFs? And how to tell the difference between NAV-eroding and stable ones. Covered call ETFs can look very attractive. You see 8%, 10%, even 15% yield, paid monthly. But here's the question most investors don't ask. Is that income sustainable? Or is your investment slowly shrinking underneath? Today, we'll break this down in simple terms. The problem. Many Canadian investors, especially those focused on passive income, are drawn to covered call ETFs because they pay high monthly distributions, feel safer than individual stocks, seem perfect for TFSA or retirement income. But there's a hidden issue. Some covered call ETFs generate steady income while keeping their value relatively stable over time. Others generate high income by effectively giving you back your own money, slowly reducing their net asset value or NAV. If you don't understand the difference, you might think you're earning income, when in reality, you're slowly liquidating your capital. So let's simplify this. To break it down simply, what is a covered call ETF? A covered call ETF does two things. It owns a basket of stocks. It sells call options on those stocks to generate extra income. That options income is what helps create the higher distribution. Think of it like this. Owning stocks equals owning rental property. Selling calls equals charging someone a fee for the possibility of buying your property at a fixed price. You collect that fee whether the stock goes up or not. That sounds good. But here's the trade-off. When markets rise strongly, covered call ETFs often cap their upside because they've sold those calls. That's normal. The real issue is something else. Are they generating income from option premiums and dividends? Or are they paying distributions by slowly reducing the fund's value? That's where NAV behavior matters. Here are a couple of practical examples in Canada. Let's look at real examples from the Canadian market. NAV-eroding type. Examples often discussed. Hamilton ETFs, products like HDIV. Purpose investments, products like PAYF. These types of ETFs often use leverage, target very high yields, maintain fixed distribution targets. If markets are flat or weak for extended periods, the ETF may maintain its payout by realized gains, option premiums, or returning capital. Over time, if distributions exceed total return, the NAV can trend downward. This doesn't mean they are bad, but they are often designed for income priority, not long-term capital preservation. They may suit investors who prioritize high cash flow, retirees comfortable with lower growth, but they may not suit long-term compounding-focused investors. More NAV-stable type. Examples include BMO asset management products like ZWB, BlackRock Canada iShares covered call ETFs. These funds typically do not use heavy leverage, cover only a portion of the portfolio, for example 30 to 50%, allow distributions to fluctuate with income. Their yields may be lower, perhaps 5 to 8% instead of 12 to 15%. But the NAV tends to be more stable over long periods. They may suit long-term investors, TFSA holders focused on steady passive income, investors who want balance between growth and income. The key difference: NAV-eroding model, high payout target, distribution prioritized, NAV may slowly decline. More stable model, income generated from portfolio, distribution reflects reality, NAV more stable. Here are the key mistakes to avoid. Chasing yield alone. A 14% yield is not automatically better than 7%. If the 14% fund drops 8% per year in value, your real return may be lower. Always look at 3-year total return, 5-year NAV trend, distribution history, ignoring total return. Income feels good because it's visible. But total return equals price growth plus distributions combined. A lower yield ETF with stronger long-term total return may build more wealth. Putting 100% in one high-yield product. Concentration increases risk. Even within covered call strategies, diversification matters. Assuming monthly income equals safe income. Covered call ETFs are still equity investments. They are not guaranteed. They can decline in bear markets. To summarize, covered call ETFs are tools. They are not magic income machines. Here's the simple takeaway. Some prioritize high payouts and may experience gradual NAV erosion. Others aim for balance between income and capital stability. The difference shows up over time, especially in total return. If your goal is long-term passive income, TFSA compounding, financial independence, then understanding the structure behind the yield is essential. High income is attractive, but sustainable income is powerful. And as long-term investors, sustainability matters more than excitement.